This is Noel McIntosh with McIntosh Associates here in your mailbox for this week's market update. Well, don't fall for the inflation head fake. Last week's inflation report for June surprised to the downside, reviving hopes for potential rate cuts later this year. But does anyone really think inflation has gone away? All that happened was that oil dropped from around $93 per barrel at the beginning of June to just below $69 a barrel by month end. We previously documented that the events that led to the oil's decline back down to where it was trading when the Iran conflict began. By the end of June, a ceasefire was mostly in place, a memorandum of understanding was signed, and meetings were set for the next 60 days to iron out the details. Plus, the new naval blockade of Iran was lifted. Iran would be allowed to sell oil on the international market, and the Strait of Hormuz was opened up. All that drove oil prices sharply downward. Oil and other forms of energy are used pretty much by everyone for everything. When oil prices decrease, so does the cost of doing business. Your personal costs also decline alongside the price of gas. So when the consumer price index dropped from 4.2% in May to 3.5% in June, the consensus missed by a wide margin, and the financial media called the result a surprise. But the surprise didn't last long. Things blew up again in the Gulf, and oil is now back over to $80 a barrel. Next month's inflation reading will likely jump back up to 4% or more, and the price of gas is climbing back up. There are two common ways to get inflation. The first is to get people money to buy things while keeping the supply of those things the same as before the additional money was given. This spikes demand and prices rise. We saw this back in 2022. The second is if energy costs rise, then the cost to produce those things must increase. That's where we're going through right now. That brings us to core producer prices, which also comes in lower, 4.7% in June versus 4.9% in May. Consensus was actually calling for producer prices to increase to 5.2%. This is mind-blowing, especially since producers should benefit initially from any price declines, which they do, and then take their sweet time passing on their lower costs to consumers to maximize profits. The clearest example is at the gas station. As soon as the price of oil goes up, so does the gas prices. When oil declines, the price at the pump goes down much less quickly. We probably shouldn't believe the energy-driven inflation spike is over, or be fooled into thinking that things are improving. With oil back up and the situation with Iran still in flux, inflation may pop right back into where it was in May. This isn't over by a wide margin. Tensions in the Middle East will re-escalate. After Iran attacked some ships in the Strait of Hormuz and two military bases in Jordan, President Trump said enough was enough and ordered new strikes further degrade Iran's military capabilities. The markets have lost interest in the Iran situation. As long as oil hovers between $75 and $90 a barrel, yields may stay where they are, and markets will focus on other things. The heightened tensions barely impacted the markets last week. Instead, it was all about tech stocks and chip stocks and AI. The same old arguments keep boiling up. Are cheaper AI open source models challenging our dominance? Are we spending too much on data centers? Is there hostility toward data center construction, and will construction be delayed or stopped? And the debate goes on and on. The markets need to readjust because we are near market highs once more. There's really nothing new to propel us forward, and we continue to trade in the range until the next big thing comes along. That could mean a permanent cessation of hostilities in the Gulf, which would crater inflation and let us start talking about other things. Until that happens, market will be tentative and keep looking at the situation as a glass half full scenario. Well, coming this week may be one of the slowest weeks of data all year. Monday will feature only leading indicators, and Federal Reserve Board of Governors closed Monday. The only data released on Tuesday and Wednesday will be MBA mortgage applications. Thursday will feature weekly job claims and KC Fed survey of business. Pending home sales and U.S. flash manufacturing and services PMI will be reported on Friday. This is what will get you into the depths of summer, but the tech sell-off could reverse on a dime, where while the Iran situation may hammer markets, this is where the old saying, go away in May, comes from. If you step away from the markets, you could avoid a lot of summer turmoil, but you also can miss a lot of growth like we saw last summer. Our advice right now is to stick with your plan. Don't get too caught up in the headlines, and make sure if you have any questions to give us a call at 989-692-2200 or check our resources at focuswealthplan.com. Have a great rest of your week.